Greetings class and welcome to the final review video for the course. What I'm doing in this video is a few announcements and also kind of going through some of the problems of the type that will be on the exam. So by way of announcements, I just want to remind everyone there's a chapter 12, 13, and 14 vocab quiz that's still available. Make sure you get to that. Also, and that will be due on Friday, May 1st by 11:59 p.m. And then there's a Chapter 13 assignment that's due on Wednesday, the 29th. Make sure that you get to that one. That's also due by 11:59. And then the last thing I want to mention is the discussion for today. It's due today or tonight at 11:59. Make sure you respond to those three questions that I've posted in the discussion prompts. So today, like I said, I wanted to remind you about those three things and also to let you know that I have been looking at your comments in the discussions and I appreciate the feedback that's included there. I want to check in with you, see how you're doing, make sure you're doing okay. I'm going to go into a discussion about these exam review problems that I have here. So I've uploaded this final exam problem review here, which is the document that includes the problems, along with a worksheet here that will enable you to work through these problems. You can do that along with the video or separately as you wish. It'll help you to practice those problems. And I think that will prepare you very well for the problems of the type that will be on the exam. So once again, the exam information here. This is the multiple choice review. What I'm letting everyone know is that these are the types of multiple choice questions that will be on the exam. This is the material that will be covered, and there may be questions that are slightly different than this, but these are of the type that you will see on the exam. So I want to be very clear. This exam will look a lot more like the second exam rather than the third exam. Again, I'm moving forward with this, creating this to be a lot more like the typical exams that I give. So if you study these multiple choice questions and these problems, you will be covering the content that I want to cover in the exam. So make sure that you do those or look at those. These are like a practice test here. This final review, multiple choice, and final review for problems will be like a practice test. Once again, on the final exam, I anticipate there being about 30 questions, somewhere in the neighborhood of 25 or 26 multiple choice, and 4 or 5 problems. Again, the total will be 100 points, and you will have an extended period of time to work on these rather than the one little over an hour that we had in the last exam. You will have a little over 2 hours to complete this. So that's the way the exam will look. Let me know if you have any questions about that. But for today, I wanted to go through these example problems that I put into this review document here and the worksheet. Okay, this is the review problem document, PDF. This is the first problem right here. The management of Wingle Corporation is considering dropping product B90D. Data from the company's accounting system appear below, and they give us the sales, variable expense, fixed and manufacturing and selling expenses. And then all fixed expenses of the company are fully allocated to products in the company's accounting system. Further investigation revealed that 173,000 of the fixed manufacturing expenses and 150,000 of the fixed selling and admin expenses are avoidable if product B90D is discontinued. So what would be the financial advantage or disadvantage of dropping B90D? Now this is a financial question. You have to come up with with what is the exact financial advantage or disadvantage of discontinuing this. In order to figure this out, we have this schedule here that I've prepared in the Excel workbook that is the student review worksheet. And so we're going to look at it in two different ways. We're going to look at keeping the product, what will it be like if we keep it, what will it be like if we drop it. So if we keep the product line around, we'll still have the 720,000 in sales. We'll still have the 374,000 in variable expenses, and we'll have a contribution margin of 346,000. We'll also have the full fixed expenses that we had of 245,000 in manufacturing and 209,000 in sales and admin. So the total expenses then will be fixed expenses 454,000, so that we'll have a net loss of 108,000 for the product. Now, if we drop it, we're not going to have any sales, we're not going to have any variable expense, and we're not going to have any kind of contribution margin. So what that means is that for the sales, that's a loss of something, so that's a negative. We're not going to have what we would normally have. But the advantage is that we will also be losing the expenses, which is a positive. However, the net of these two is going to be a negative. We're going to basically be giving up the contribution margin that we would normally have that would contribute to the fixed expenses. Now, if we drop the fixed manufacturing expenses, or if we drop the product, the fixed manufacturing expenses will drop by 173,000 from 245. So we need to include that here. So we're going to take the normal expenses that we have of 245 if we keep the product minus the 173 we will save if we get rid of it. So we drop it by 173,000. We still have 72,000 in expenses. Likewise, with this fixed selling and admin expense, we're going to drop it by 150,000. So we take the 209,000 that we have with the product minus the 150,000 that we have if we drop it. We have a total expense of 131,000 that still remains, but we have no contribution margin. So we're going to basically have a loss, continued loss of 131,000 without the product. Now, dropping these expenses is a positive, so we can say we're actually going to save 173,000 here, and we're going to save 150,000 here. However, we still have a loss. So we compare these expenses with the loss of contribution margin, and when we add those two together, we still get a loss of 23,000. So in other words, dropping this product line will increase our loss by 23,000, and the financial disadvantage of dropping the line is 23,000 right here. It's that net difference. So that's a keep or drop kind of question, and that's a good way to approach the analysis. So for the second one, we have basically a question of whether we take a special order or not. Here it says Marsden Company has an annual production capacity of 15,000 units. The cost associated with production and sale of the company's products are given below. If the company presently is selling 12,000 units at a price of $28 each, a special order is received from a distributor who wants to purchase 3,000 units at a special price of $20. Regular sales are not affected by the order, and the order could be filled without any impact on total fixed cost. Sales commissions on the special order would be reduced by 1/3. In other words, instead of $3 a unit, it'll be $2 a unit. So determine whether the company should accept the special order. Well, in order to do that, we need the incremental revenues for what we're actually going to generate, which will be the 3,000 units times $20, $60,000. Then we have the variable manufacturing cost that we will still have of 3,000 units times 12, 36,000, and the variable selling costs now reduced. Instead of $3, it's $2 per unit. So we take the 3,000 times 2. And when we take the 60,000 and subtract out these expenses, we get a net advantage of 18,000, which means we should accept the special order. Okay, that's number 2. For number 3, we're going to do a payback period type question, and I want to go to that here in the document. The question is here, the management of True Love Corporation is considering a project that would require an initial investment of $321,000, would last for 7 years. The annual net operating income would be $28,000, including depreciation, that's expense, of $42,000. At the end of the project, the scrap value of the project's asset would be $27,000. Determine the payback period of the project. Well, for payback period, we're not really going to look at the end of the project and consider this scrap value. We're looking at how long it takes to recover this 321 over the course of the 7 years. So the way we're going to do this is we're going to take the net operating income of 28,000. They gave that to us in the problem. So we take that 28,000 here, and we're going to add back the non-cash expense, that's depreciation. So we're going to take the 42,000 and add it back. When we do that, we get 70,000 as the annual net cash inflow. So the payback period is calculated by taking the investment required of 321,000, and we're going to divide that by the annual cash inflow, which is the 70,000. Okay. So when we do that, the payback period is going to be 4.585 or 4.59 years, rounded to 2 decimal points. So that's the payback period approach. Just remember, this is not a cash flow approach, so you have to, or this is a cash flow approach, I'm sorry. So you do have to add back the depreciation expense, which is not actually a cash expense. Okay, for number 4, we're going to look at a net present value problem. This one says that Cooney Inc. has provided the following data concerning a proposed investment project, ignore income taxes, and they have an initial investment of $160,000. The project will be 4 years long. The annual net cash inflows will be $70,000 a year, and the salvage value will be $16,000 at the end of the period. The company uses a discount rate of 17%, and what they want us to do is to compute the net present value of the project. So we have, again, the best way to set it up is like this in a table. We have an initial investment that we're going to put into the project of $160,000, which is a negative number. Remember, when we're putting cash out, it's a negative number. When we collect cash back, it's a positive number. So for this, that's the only thing we're going to pay out in the current year. Remember, anything we pay out in the current year has a discount factor of 1. So the present value of what we're paying out is $160,000 negative. We're paying it out. So during years 1 through 4, if we look back here at the problem, we're going to collect 70,000 a year in annual net cash inflows. So we go back here and we put the 70,000 in as cash inflows. And then in year 4, we have a one-time cash inflow of 16,000 for the salvage value of the equipment. So we put that in here, 16,000. All right. Now, when we go to look up the discount factor for years 1 through 4, we're going to look at the table that is an annuity because we're looking at more than 1 year. Remember, an annuity is a series of payments, whereas a lump sum is one single payment. So we go to year 4 right here and go down to 17%. The factor here is 2.743. So we go ahead and put that in 2.743, and we multiply that times the annual cash inflows to get what the present value of that annuity is going to be. When we look at the salvage value, we need to look at the other table, which is a lump sum payment, because remember that's going to be one payment at the end of everything in 4 years. So we go to 4 years and go down to 17%, we get a factor, a lump sum factor of 0.534. So we put that in, 0.534, and then we multiply that times the 16,000 to get the present value of that. The last step here is just to add all these together. So we're just going to add all of these present values together to get a net difference. And what we have is a net positive present value of 40,554, which means we should pursue this project because it is going to create a net present value that's positive at the given discount rate. Okay. The last problem I have here is number 5, which is a simple rate of return question. And this says the management of Nixon Corporation is investigating purchasing equipment that would cost $518,000 and have a 7-year life with no salvage value. The equipment would allow an expansion of capacity that would increase sales revenues by $364,000 a year and cash operating expenses by $211,000 per year. Determine the simple rate of return on the investment to the nearest tenth of a percent. Well, for this, we need to create an income statement. So if we go back over here, I've got that laid out here. This is a good way of setting it up. We have the annual incremental net income of $364,000 for the project. And then we have annual cash operating expenses of $211,000. The one thing that we have to consider with a simple rate of return is this depreciation of this equipment, because simple rate of return is not cash flow. It's based on something similar to a return on investment calculation, which needs to have this included. So we take the $518,000 with no salvage value and divide it over the 7 years that it's going to be in service. So in order to calculate this depreciation, we take the 518 divided by 7. We get $74,000 in expense. Now we want to add those together to get our total expenses that we deduct from our total revenue. So we take our revenue minus expenses. We get a net income, net operating income of $79,000. So to calculate the simple rate of return, we take that annual net operating income of $79,000 and divide it by the initial investment, which in this case is going to be the amount we spend on the equipment of $518,000. So we want to go back and put that 518 in, and then divide that 79,000 by the 518. Okay, based on the question, they want you to round this to one decimal place, so it would be 15.3%. And again, if you are rounding this and you get a slightly different number in rounding, if you're right with the calculation, but your rounding is off a little bit, I'm not going to mark that down for that. But again, this you would need to have the 15% here if the rounding was a little different. For example, if you answered 15.25 instead of 15.3, I'm not going to count that wrong. So these are the problems of the type that will be on the exam. And once again, like I said, I am taking a step back so that this final exam will look a lot more like exam number 2. In other words, study the material in the practice test. You'll be good on the final exam. If you have any other questions, feel free to let me know. And by the way, if you need to have a WebEx session with me this week, I have virtual office hours all week, and we can meet up and talk about this and that. So let me know if you have any questions. But again, this is the best way to prepare for the test. And then once again, the final exam will open Wednesday morning and be available until Friday at 11:59 p.m. So take care. I'm looking forward to seeing how this exam works out and answering any other questions you have.